Hello there. I'm John Thanasoulis. I'm Professor of Financial Economics at the University of Warwick Business School. I'm also the Director of the Global Central Banking and Financial Regulation MSc. Part of that MSc is a module in Financial Regulation and Supervision. I think it's a very interesting module which we've put together with the Bank of England. And it's that module which I wanted to talk a little bit about today. And I'm very grateful to two of my colleagues here. Maria, who is an executive of the Bank of England, works in securitization, and Mark, who's a tutor with me on the MSc, and indeed was a very senior executive for a long time at the Bank of England and has recently retired. For the benefit of those watching, this is a module which explores some of the reasons behind different regulatory approaches that exist across different central banks and different financial jurisdictions. Central banks do differ on exactly the right level of capital that they think banks should have, how universal banks should be. I suppose, Maria, the first question is, why do you think it's helpful for colleagues of yours at the Bank of England to be aware of these sorts of debates?
When we have any case that comes from us from a supervision perspective or a regulatory perspective, we have a question to answer, then we need to take the facts and then subject them to the current rules. But sometimes the rules are not as clear as we would like them to be, or the case at hand is quite complicated. So it's exactly those cases that we need to make a right interpretation. And in order to do this interpretation, we need to know why the rule was put in place from the outset. So this is why we need to explore the political economy behind the regulation overall, and specifically for each segment of the regulation, why it was put in place, what kind of risk it wanted to capture. And also another reason would be, and this would be something very relevant to what happened some years ago in the 2008 financial crisis, that other regulators could be potentially seeing harmful behaviors of banks or toxic products that could at some point, especially when we're operating in a global and interconnected banking system, at some point we could face them ourselves in our jurisdiction. So it helps us, in short, it helps us being proactive.
Okay, that's very helpful and gives a good overview. I suppose I wonder if you'd be willing to just sort of drill down into, for the benefit of people watching, some of the roles in the Bank of England which might come very close to the sort of issues that you described, areas where regulatory knowledge of the sort that we explore in this module might really be quite valuable in looking across countries and trying to see if there are lessons that we need to learn.
That would be definitely supervision, obviously the regulatory side and policy making, because this is a bit more forward-looking.
It might surprise some people looking at the syllabus of the module to see that it explores climate change and its interaction with bank regulation. Is this an important international question, the question of how much central banks should be involved in climate change?
So one of the mandates of the Bank of England is financial stability. And financial stability, I think you also mentioned that before, has to do also with prudential integrity, as we call it, which essentially is capital adequacy of the banks. So we're trying to ensure that the banks have enough capital to be able to operate and not pose a threat to the economy and, of course, to society. And the enemy of capital adequacy is risk. And risk can come into different forms. So that could be credit, market, operational risk. So speaking of climate risk, this can reflect in all these types of risks. So it could be operational risk in the sense that the bank itself could have branches or facilities in an area that is hit by a tornado and the facilities are destroyed. It could be credit risk in the sense that the clients of the bank get into default because, for example, if they're in agriculture and we have a severe drought, then they cannot produce any crops. So unfortunately, they're not able to service their debts anymore. Or the so-called transitional risk, that the clients of the bank, if they're working if they're active in an area that, as we're moving towards a net zero economy, is no longer considered to be very socially valuable, such as in petroleum extraction, then this potentially for the bank could be less profitability in the future, at least.
Fantastic. So I think that goes a long way to explaining its inclusion. Now, there's another aspect in this module of financial regulation and supervision. It will come as no surprise that it does a lot of work on exploring regulation as they apply to banks, but it also explores the regulation that applies to insurance companies. Mark, perhaps I can approach you on this and ask why you think it's actually really valuable for students that are doing a module in financial regulation and supervision, who are likely to work in the private or public sector in finance in their jurisdictions, to understand a bit about insurance regulation.
So I think my answer would be that central banks and bankers, indeed around the world, are interested in maintaining financial stability. And the Bank of England defines financial stability as ensuring the continued supply of financial services to the economy in good times and bad. And insurance is one of those important financial services. So why is it important? Well, the world would be a very different place without insurance. Many activities wouldn't happen or would be substantially reduced in number. So how often would you want to drive a car if you knew that if you were involved in an accident, the bill from that accident could escalate into tens, hundreds of thousands, or maybe even millions of pounds? If you did have an accident and the person in the other car was injured and they were no longer able to carry on doing their job, then they might sue you for loss of lifetime earnings, and that bill could easily escalate into hundreds of thousands, even millions of pounds. And the same kind of argument could be made for business activities. Indeed, you might want to multiply it up. Henry Ford, the founder of Ford Motor Cars, has got a great quote which sort of summarizes his point very effectively, I think. And he said, New York City has only been made possible by insurers. They are the ones who really built this city. Without insurers, there would be no skyscrapers. No investor would finance buildings that one cigarette butt could burn to the ground. So insurers play an important role in taking on the financial risks of others. It allows us to lead better lives and it enables a more productive economy. But insurers also play an important role as investors because unlike banks' deposits, insurers' liabilities can't be withdrawn quickly. And as a result of that, they can be important long-term investors. So the Financial Stability Board estimates that total global assets of insurers in 2020 was around $39 trillion, or 17% of the non-bank financial sector. So insurance is an important part of the financial system, and as a result, it's one that central bankers and indeed all bankers around the world need to be aware of and to understand, and that's why insurance is on this course.
Fantastic, thank you, Maria. If I could turn to you for some more concluding comments. I want to explore the idea that the Bank of England, perhaps in common with many central banks, appears to be very keen for widespread knowledge amongst its staff. It is keen to advocate learning across a large swathe of its employees, and sees a benefit to not just a small number of experts knowing about political economy, financial regulation, the particular rules, but having a good depth of knowledge spread across the organization. Can you explain a little bit about why and how, for the individuals, it can be useful to them to know more about the landscape of banking?
I think, first of all, to start with the fact that the Bank of England, and I assume that other central banks, want to be true to their values. And this is definitely the case in the Bank of England, that wants to share knowledge with everyone working in the organization.
I think this is an excellent module. I hope that people viewing this will want to find out more about it. I've enjoyed writing it with Mark, and I'm grateful for the input of Maria and her colleagues as we put the syllabus together. So with that, allow me to conclude really just by saying thank you, Maria. Thank you, Mark.